Hey there, and welcome to this explainer. If you are a focused learner looking to cut right through the noise and understand exactly what is happening with regional banks right now, you are absolutely in the right place. Today, we're breaking down the Q1 2026 earnings report for Simmons First National, trading under the ticker SFNC. And let me tell you, there's a massive hook here right out of the gate. They just posted a blistering 10% annualized loan growth. For a regional bank in this environment, that is a number that demands your attention. Okay, let's dive into this. Here is our roadmap for today. We'll start with a quick snapshot of Simmons First, see how their Q3 repositioning is actually paying off, look at what's driving their strong loan growth, navigate through some credit risks, check out the latest analyst ratings, and finally, lock in on their 2026 financial outlook. Let's get to it.
All right, part one, the Simmons First snapshot.
So, the headline number for the first quarter of 2026 is a diluted earnings per share of 47 cents, and what that actually means in real dollars is a very solid $68.5 million in net income for the quarter. Now, yeah, that's slightly down from the fourth quarter of 2025, but it represents some seriously significant, sustainable profitability. But to really grasp how they are generating these high-quality earnings today, we kind of have to look backwards at a major strategic move they made last year. Which brings us to Section 2, how their Q3 repositioning is paying off.
Okay, so back in the third quarter of 2025, management pulled the trigger on a balance sheet repositioning. Basically, in plain English, they intentionally shrank the bank just a bit to make it way more profitable. They went ahead and paid off those super expensive Federal Home Loan Bank advances and actively dumped high-rate, non-relationship deposits. And look, it was a painful move at the time. They took a loss on selling some securities, but it completely rewired the bank's earnings profile, for the better.
And this brilliantly illustrates just how well that pivot worked. In Q1 of last year, their net interest margin, which, if you think about it, is essentially a bank's profit margin on lending, was sitting at 2.95%. Today, post-repositioning, that margin has absolutely surged to 3.84%. I mean, that is a massive 89 basis point jump year over year. Basically, by ditching that expensive funding, every single dollar they lend out today is just significantly more profitable.
Moving on to Section 3, driving strong loan growth.
SFNC didn't just grow. They posted an incredibly impressive 10% annualized loan growth. That pushed their total loans to a record-breaking $17.9 billion. But honestly, arguably just as important is their 13% annualized growth in average low-cost deposits. Management is chalking this up to a multi-year push for organic growth, bringing in some fresh leadership talent, and just keeping a really healthy pipeline. They're literally funding high-yield loans with low-cost, sticky deposits. I mean, that's the holy grail of regional banking right there.
All right, Section 4. Navigating credit risks.
Now, we have to look at the full picture here, and honestly, credit did show a little bit of stress this quarter. We saw a roughly $30 million bump in non-performing loans. Now, quick caveat, it's highly isolated. About $18 million of that is tied to just one single construction relationship. Aside from that, research platforms like Simply Wall Street have flagged a couple of things to keep an eye on, specifically some potential concerns around dividend coverage and recent shareholder dilution. Definitely key items that investors need to track closely.
But even with that $30 million bump in non-performing loans, management is actually pretty relaxed. They expect their actual loss limits to be totally contained. Why? Well, they've got low loan-to-value ratios and fresh appraisals on the underlying real estate. So because of that, they're sticking to their guns and maintaining their guidance of just 25 basis points for full-year charge-offs. They seem really confident that the structural integrity of their loan book is rock solid.
Let's pivot to Section 5, Analyst Ratings and Targets.
So, the crucial point here, looking at data from MarketBeat, is that out of 9 Wall Street analysts covering the stock, we're seeing 2 strong buys, 2 buys, 5 holds, and, this is key, absolutely 0 sells. That gives SFNC a consensus moderate buy rating. Now, the average 12-month price target is sitting at $22. And sure, that implies a relatively modest upside from where it's trading right now, but the fact that there isn't a single sell rating, that really suggests analysts are recognizing the serious downside protection that got built in during that recent restructuring.
And finally, Section 6, the 2026 Financial Outlook. On the recent earnings call, President Jay Brogdon dropped a great line. He said, "We flipped from liability-sensitive to slightly asset-sensitive. I feel pretty good about the plus on the 5%. So what is he actually saying there? Basically, the bank is now positioned to thrive even if we see some minor rate cuts. Thanks to that built-in resiliency, management is publicly stating they expect to hit the absolute top end of their 9 to 11% net interest income growth target for 2026. And when we talk about returning value to shareholders, SFNC has a, frankly, incredible 117-year track record of paying dividends. Just an unbroken streak that they are rightly super proud of. On top of that, they've still got $175 million left in their 2026 share repurchase program. Management was clear that they're being patient, but since they feel the stock is trading at a pretty low forward earnings multiple right now, they are absolutely ready to be opportunistic with those buybacks. Which really leaves us with this final, kind of provocative question. You've got a bank here that just grew its loans by 10%, expanded its profit margins by 89 basis points, and is literally tracking toward the very top of its income guidance. And yet the consensus Wall Street price target is just a modest $22. So is Wall Street totally underestimating the sheer momentum of Simmons' first national strategic turnaround? It is a really fascinating tension between these conservative analyst models and just undeniable operational results. Something to chew on as you dig into the numbers. Thank you so much for joining me for this explainer. Keep learning, and I will catch you on the next one.